In part one, we covered the birth of a company. Seed financing, startup capital, the early growth window where venture capital prints money. But that's only half the story. Because what happens after the venture capital phase? What happens when a company is actually successful, mature, and worth billions? And what happens when it starts to fall? Today, we're finishing the life cycle: expansion, replacement, and vulture. The three stages where real deal complexity lives. LBOs, what a buzzword, pipe deals and hostile takeovers, poison pills, and bankruptcy courts. Let's get into it. Quick recap of where we are. Development, startup, early growth, that's part one. That's VC. Today, we're doing expansion, the world of adult companies. Venture capital is done, the product works, and the business is real. So the question is, how do we grow, transition, or just survive? Okay, stage 4 is expansion, and there are two very different ways a company can grow. Path 1 is internal, or organic growth. You invest in new assets, you build out your working capital. Maybe you just need a factory, a new software system, or even more staff. This is simple, you just need money, don't we all? But you as a business owner has options, bonds, mortgages, or even open lines of credit. But maybe you need a certification to enter a new regulated market. Knowledge capital, not just financial. That was from episode 1. And here, the company will shop around until they find the best deal, which can be private equity. And here, private equity is hands off. They have a light touch. Now, path 2 is something you're going to love. It's external, and it's called mergers and acquisitions. Buying an entirely different company to enter a new market or business area. But this is complicated. You definitely need an advisor. Now that mergers and acquisitions, another buzzword, advisor, is often Blackstone itself, and it does 4 things. Number 1, it finds a target company they want to buy. 2, they negotiate the price of buying that company. 3, they provide the acquisition capital or the money to buy the new company. And 4, they handle the legal work and tax. For this external expansion, private equity goes fully hands-on. They're going to be in every room. Now you might be asking, how does a company actually acquire another one? Well, for this, there are 2 routes. Route 1 is a direct shared deal. The company trades shares for cash and buys the target outright. The investor gets a share of the synergized company or the merged entity. So if the acquisition creates massive value, then the investor wins big. It's simpler, more investor friendly, but it dilutes existing shareholders. Now route 2 is a little tricky. It's called the SPV structure. SPV stands for Special Purpose Vehicle. It's basically a shell company created for one purpose, to collect money and buy the target. Private equity will create the SPV. The SPV raises money from banks, and then the SPV buys the company. The investor does not get a share of the synergies, and that's the trade-off. But it keeps the parent's company balance sheet clean and no new debt piles up. Now you might be thinking this is a great deal for businesses and not the investor. But there's a few catches you need to be aware of. Number 1, this structure is way more expensive. And number 2, private equity firms are less motivated because there's a smaller payoff for them. And you need to make sure the banks agree to lend the SPV. That is never a guarantee. Now Blackstone, they play both routes, depending on the deal, the target, the trust, underlying trust there, and who wants what. Okay, stage 5, maturation. And this is where the DNA of private equity completely changes. Replacement financing is not about injecting money into the business as all the other stages are. This company doesn't need cash. It's mature. It's making its own money. What it needs is a new shareholder. An early investor wants to cash out. A founding family wants liquidity. The ownership needs to change, and that's where PE comes in. Now there are 3 types of deals that dominate the stage: the LBO, the pipe, and corporate governance deals. Let's go one by one. Now everybody listen up. This is one of the most discussed aspects of private equity, and I'll be doing a video breaking it down later. So subscribe and make sure to comment what part of the LBO we need to elaborate on. So, the LBO, the leveraged buyout. 40 to 45% of all private equity is based on this one deal type. It is the bread and butter of firms like Blackstone, KKR, and Apollo. Here's how it works in 5 simple steps. Step 1, find the target. Private equity identifies a company with a low debt to equity ratio, real cash flow, and assets you can sell. Low debt means there's room to load it up. Cash flow services the new debt, and liquid assets equals the escape hatch. Step 2, create the SPV. Private equity puts in 10 to 20% equity. Banks lend 80 to 90%. Look at that structure. That tiny gold slice is what PE actually puts in. That blue wall of debt is what blanks contribute, and that is the leverage. Step 3, acquire. The SPV buys 100% of the target. This can be peaceful, a negotiated deal with management, or hostile, a massive grab on the stock exchange the moment they go public. The more aggression, the more debt involved. And step 4, this is the critical one. The target company inherits all the debt of the SPV. The company just got acquired, and now it owes hundreds of millions of dollars to the banks. Step 5, private equity exits fast. They are not trying to manage this company. They clean up the assets, repay the debt, sell, pocket the difference, and move on. This is the play. So now on to the less popular type, but still super important to know. The second deal type is PIPE, or public investment in private equity. Here's the setup. The PE firm buys a minority stake in a publicly listed company. Minority stake. That means they don't own the whole thing. So what's the angle? The gamble is that the minority stake might be enough to determine who controls the company. In fragmented ownership structures, 5% can make you the largest single shareholder. You are now the kingmaker. You buy on the exchange, you find a buyer off the exchange, and you do a private negotiation. You sell at a 3-4 times price of what you paid, and no public market pricing. You have all the leverage. A real-world example would be European banks. They're publicly listed with fragmented shareholder bases. Private equity firms have used PIPE deals effectively to hand over control of banks without ever buying a majority. The third deal type is corporate governance deals. Old money family businesses, succession crises, and generational conflicts. Private equity buys a stake, redesigns the governance structure, and solves the ownership mess. Then it sells, clean in and clean out. The key difference here, the risk is not primarily financial, it's reputational. These families have names, legacies. Getting it wrong is embarrassing in ways that can't be quantified. Now don't worry, we are going to build that family wealth one day. Now the final one, stage 6. The company is in trouble. It's not growing, it's not stable, it's declining, or worse. There are 2 types of Vulture deals, and the defining variable is how bad is it. Type 1 is restructuring financing. The company is in crisis, yes, but it is still alive. It needs money, but it also needs a completely new strategy. It needs fixed assets, new management, and payments to suppliers it can't cover. Private equity here plays a dual role. It's a consultant and a financer. They're going to invest to take a majority stake, and then they're going to rebuild the company from the inside out. It's not common, and it's extremely risky. And honestly, it overlaps heavily with investment banking territory. The debt negotiation, the bankruptcy law expertise required, that's IB's home turf. Type 2 is distressed financing. The company hasn't just stumbled, it has defaulted. It has failed to meet legal financial obligations, it's breached loan terms, the company is legally broken. Private equity is not trying to save the business, it's after the assets. It's after the brand names, the machinery, the real estate, the IP portfolios. Then it trades those assets or injects them into other portfolio companies to boost their value. When a company defaults, the court takes over, and the court's job is not to help the private equity investor. Their job is to satisfy banks, suppliers, and creditors in that order, which means private equity is trying to buy assets in a system designed to not give them a deal. Professor Stefano Caselli at Bocconi University in Milan has a term for what happens next. It's called the poison pill. To get the good assets, you have to buy all the bad ones too. The court bundles the assets you want with garbage assets nobody wants. You want the brand, you're going to get the broken machinery, the worthless real estate. This is the most common in countries with high default rates or low GDP. The legal system shapes the deal. Which brings us to Chapter 11, the U.S. Bankruptcy Code, and why distressed deals work best in America or like countries. Chapter 11 lets a company reorganize while still operating. It's not instant liquidation, it's a structured court process. With defined creditor priority, clear asset sales, there is room for private equity to negotiate. Now, internationally, the outcome quality equals legal system quality. While some countries make distressed deals impossible, others are wide open. Now, Blackstone's credit and distressed teams map every jurisdiction for exactly this reason. You gotta be aware of the playing field. And now you have the whole picture. 6 stages, 6 financing types, $1 trillion firm playing every single one of them. Development, fund the patent, not the company, the idea. Startup, build the machine, protect yourself with put options, collateral, and aligned equity. Early growth, 3 years in, the VC profit window opens, go hands-on and make money. Expansion, grow internally or acquire. M&A is complicated and get the advisor. Maturation, replace the shareholder. LBO, pipe, or redesign the family governance. And then finally, decline. Restructure while there's still a pulse or pick up assets from the wreckage. Private equity doesn't have one strategy. It has a framework built for every phase, every risk profile, every type of crisis. Blackstone doesn't just survive market cycles, it profits from every single one. Now, if this series helped you understand how big money actually moves, please hit like. And I want to hear you from the comments asking me about what surprised you about the LBO structure, or the M&A acquired company taking all the debt, or was it the poison pill that really got you? Drop it below because I read every comment. I'm learning in public. Thank you for listening. Subscribe.